So you're thinking about becoming a homeowner. For the first time, you're thinking about buying your house, buying an investment property, or maybe you purchased one quite some time ago and you need a little bit of a refresher of, wait a minute, it's been a long time. I'm not doing this all the time. What do I need to know? How do I need to think about? What are the things going out there that we need to talk about and understand to be homeowners? And maybe you don't have anybody in your life that you can ask some of these questions. And so now I welcome you to this episode where we talk about the first time home buying and what you need to know and understand. Now, before we jump into any of the things that you see behind me, I want to go out and cover some stuff, and that is things to consider whether you're thinking about being a homeowner or not. One of the things to understand and think about is that it's a bit different and potentially easier to be a tenant than it is to be a homeowner. As a homeowner, you don't have a luxury of just picking up the phone and calling somebody when something breaks in a house. Oftentimes, you're going to have to figure out how to do this and fix it on your own. Or even if you do make a phone call, you might need to start researching and finding folks that are available to come in. And of course, above all, then be prepared to pay the full price for it. As a tenant, you often don't have to worry about those things. You can sit on a couch, sipping your latte while they're defrosting your pipes. As a homeowner, you might still be sitting on the couch, sipping your latte, but you're also going to be counting of, OMG, they are charging how much per hour for that? Yes. So here are some of the things that I want to share with you, because now that you understand a bit better of what homeownership might require from you to do, you might decide that, you know what, being a tenant is not that bad. So that's one of the things. Second one is if you like to travel and move a lot, perhaps being a homeowner might not be the best case scenario. It just might be easier to rent and be able to move that much more flexibly. If you don't want to go and have some staycations where you are fixing things, painting things, refurbishing, or putting new additions, again, home ownership might not be for you if that's not exciting to you. Now on to the things, if this is not a deal breaker for you, of what you can do and what you need to know. There's certain things that you need to know and understand when it comes to home ownership. Credit, down payment, and DTI, which is debt to income ratio. Now, credit, you'll know that there's a thing called credit score that ranges from anywhere about 450 to about 850, and it's going to depend, the numbers are going to be a bit different, and range is going to be a bit different going from agency to agency. There are 3 different agencies, and so don't be surprised that when you pull your credit score from one of the agencies and bank comes up with something different, there's a discrepancy because maybe the time and maybe they used a different agency than you did. Now, the bottom line is you want to have a minimum of 580 or more. Of course, the higher the credit score that you have, the better terms of the loan you're going to get, and you're going to be able to save quite a bit of money. So if you have 580 or below, you might want to spend a little bit of time, a few months, working to improve your credit score before you go and shop for a home, and of course, mortgage to come with it. When it comes to down payment, it can go range anywhere from 0 to 100%. 0 basically meaning you put no money down to purchase a property, and 100% being cash payment. If you're considering cash versus finance and which one is better, I have done a video and I encourage you to watch it because I want to make sure that you understand completely what you might be getting yourself into whichever decision you make. Of course, the best way to go is to be informed and then make a decision, as opposed to make a decision without understanding all of the concepts. Now, the 0% is typically with Veteran Affairs, and there are some other agencies that might provide for some of that. However, you will be typically paying a bit more for the cost of that money that you're borrowing. However, for some folks, that is the way to go, and that's okay. The conventional loans are going to require anywhere from 10 to 20%. Some of them will be as low as 5%. And then, of course, there's a thing called FHA, which is 3.5%, that vast majority of individuals do qualify for. And that is reserved for first-time home buyers, but it doesn't mean that you've never owned a home. There are certain stipulations that exist out there that are changing and shifting ever so slightly, and sometimes counties and states, even the cities, have different programs to encourage folks to buy homes. So make sure you inquire within and learn more about your particular location. And let's jump on to DTI, debt to income ratio. Now, I've done a video about debt to income ratio and explaining how the whole thing is, but I want to briefly recap it here just so you have a brief concept. Then I encourage you to watch the whole thing to understand even more. Debt to income ratio, basically the preferred ratio of what folks want is that your debt of the home, basically the mortgage, insurance, taxes, HOA, and that should be about it, is going to be less, 30% or less from your gross income. Gross income is basically income before taxes. How do you calculate this? Well, just take the amount that you have to pay every month, divide it by the income, and voila, you have yourself a debt to income ratio. Now, of course, they also look at the back end. The back end is basically all of the debts plus the housing. So when they add all of that up, they are looking for that to be no more than 48% on most instances. However, we have found that there are quite a few different banks and lending institutions that will lend as much as 50% debt to income ratio. Of course, higher this goes, you are going to have to pay a bit more. Same thing with 3.5% down payment. You're going to have to pay PMI, which is private mortgage insurance, basically making your monthly payment that much higher. Not a lot, but it does add up. So all of those things are things to consider when you go out to shop for your first home or even an investment property. With investment property, please understand that 3.5% is not an option unless you follow one of the rules that I'm going to explain here. So now, let's talk about some of the things that typically banks, mortgage institutions, lending institutions will not talk to you about, but I want to make sure that we cover that because it is important. First thing first, reserves. You absolutely want to have some reserves when you go out to purchase your home. The reason you want to have that is that in case something breaks, in case something happens, you want to have some cash liquid. You don't want to have it in investment. You don't have it tied up. You want to have it in a checking or savings account. CDs don't count because you're going to have to pay penalties to withdraw early. So checking and savings only. Money market is okay, but again, there's a little bit of risks, and if you know anything about me, you know that I'm very risk averse, meaning I don't like to take a whole lot of risk unless I absolutely have to. So have about $1,000 is what I recommend for most homeowners. Again, it depends a little bit on the price of the property and different components, right? Like your debt to income ratio and all these different things kind of come to play. But about $1,000, at least $1,000 is going to work for most individuals out there. Now, when you go out there and something happens, you no longer have to worry that your home ownership dream turns into a nightmare overnight. You can simply have some cash to pay for some of the things to get fixed and not have to stress as much about it, having to borrow when you no longer have ability to borrow and you're all tapped out. The second thing that the reserves will help you with is when it comes to shopping for insurance. Homeowners insurance is absolutely crucial and you must have it. Now, if you're financing it, the bank is going to require it. If you're buying it all cash, nobody's going to require it, but I still highly recommend that you do take insurance and protect your home or investment property if that's what you're purchasing. When you go to buy insurance, you want to make sure that you look at what is the amount of money that you have to cover. Most of the insurances, the way they work is that you put a little bit of money, they cover the rest of it. So you're used to that with the car insurance as well. They work the same way. Sometimes the minimum is going to be $250, sometimes it's $500, sometimes it's $1,000, sometimes it's $5,000. It's really going to depend. And the higher the premium, the higher that, not premium, but the higher the amount of money that you put down, the lower typically the premium is per year. However, do ask questions when you're shopping for insurance to see, is there really a movement? Sometimes you will see big movement if you go from $500 to $1,000, and sometimes it will be barely any movement, so it doesn't make sense to go to 1,000, just stay with the 500. Gotta go and understand, ask those questions before you commit. Final thing that I want to talk about is consider getting into multifamily property. The reason for that is that as long as you buy 4 units or less, you can still get in with the FHA, that 3.5% in down payment, which is going to allow you to purchase properties. Now, I understand you're saying, I don't want to have anybody above me or below me, but maybe there's a property that has an in-law apartment above the garage that is a 1-bedroom apartment that you can maybe rent for $300. If your mortgage is $700 and you can rent this for $300, guess what? You just have decreased your out-of-pocket money that you have to pay for your mortgage down to $400. That $300 difference you can pocket, you can save up for another investment, go on vacation, or do whatever it is that you need to do. Oftentimes, if you invest correctly and pay attention to the income as well as the expenses and the price of the property, you can make your personal residence free or even get paid to live in it. If that is of interest to you, I invite you to watch the video that I did of how I teach my students to go out, own properties, and actually get paid to live in them. Thanks for watching. If you have enjoyed this video, please give me thumbs up, subscribe, let me know, put things down in comments if there's anything missing that you want to know that I should do more information on. Make sure you share this video with others with whom you believe this is going to help. And until next time, stay forever money blessed, and do remember, you are only one deal away.
I want you to be happy. Don't you want to be happy? I want to be happy.